What's up, you guys? It's Greg. So today we're going to be talking about the best investments to make in your 20s. So I thought this would be a good video topic to cover because I'm 29, around the corner from 30, and I thought it would be good for me to reflect and look at all the both bad financial decisions as well as the good financial decisions that I've made and some ones that I may tweak if I knew, what I know now back then. Now, I know a lot of my viewers between 25 and 35. So, if you haven't started any of these steps, it's not too late. All these ones I'm going to list out, you can just pick one and then it'll continue to snowball from there. So if you're 35 or you're 40 and you're watching this video, don't be discouraged because it's never too late to start. So none of these are in like a super specific order, but I'm gonna go ahead and put number one as invest in real estate. Now for me personally, this is a good investment strategy because it's fairly low risk. That meaning that I can go ahead and look at a property and be like, it's valued at this, I'm gonna put this much into it and then it's gonna be valued at that. So for me, it's fairly low risk. And this is something I wish I knew earlier in my 20s because I may have started investing sooner. Now, if let's say you're younger, you're 21, 22, or even 30 and you don't have a family, you don't have a wife and kids, you can go ahead and take advantage of the opportunity of either buying a duplex, which would be like house hacking, and living in one unit and renting out the other unit, even if you're not planning on staying in the area that you currently live, forever. Between now and when you actually move, you can set up a good system. You can have a manager, or you can just take advantage of some natural appreciation. Even if you don't necessarily find a good deal in real estate, like an under market deal, and then do some fixing. Even if you just buy a deal that's, okay, you got a good deal for a typical home buyer. By the time you move, you can sell it, or you can just hold it for long term, keep it as a rental, and then sell it, after 30 years. You will just benefit from some natural appreciation because home prices are, going to continue to go up as time goes on. Coming in at number two, I have invest in yourself. Whether for you that would be go to college and get a degree, or go to trade school and learn a trade, or get an apprenticeship, whatever that would be. Education is very important. If you want to become a real estate investor, it might be worth it trying to find somebody that's big in real estate investing and learning from them. That's a form of education. If you're like, no, I really want to trade stocks, I really want to get good at it, I want to become a day trader, it probably would benefit you to learn some fundamental and technical analysis so that you can increase your odds of being successful at trading stocks. And I know a lot of people go to college just to go to college. It's not uncommon, you go for the experience, but it's still a step that people take to invest in themselves, and it's a good step to take. And there's plenty of avenues to take when it comes to investing in yourself. There's Audible, there's a library, there's books, there's YouTube videos on how to start a business. Just invest in yourself. And number three, we have invest in your finances. Now, whether that be, purchase Dave Ramsey's Financial Peace University or purchase the software that helps you keep track of your monthly budget, investing in your finances is extremely important, regardless of age. This is a really good habit to get into in your 20s, but if you're, past 20, past 30, past 40, there's never too late to get a hold of your finances. And being in control of your finances is like dieting. You can't do it for 20 days or, you can't do a crash diet and then expect everything to come together. It's going to be slow lifestyle changes as time goes on, and then you're going to become, more debt adverse. You're going to have a better understanding of where your money's going. You're going to be less likely to spend on things you don't really need. So this is definitely something that a lot of people don't invest in, is investing in their finances. Because this isn't a topic that our economy teaches. We're a capitalist society and consumerism is big. You want to keep up with the Joneses. And to keep up with the Joneses, you have to spend. So again, like I said, any of these things that I've mentioned, you can just go ahead and pick one and just continue to snowball them. So again, looking at all these financial literacy topics, you can't just go ahead and just grab all of them and be like, I'm going to do it right now. No, it's a slow progress of increasing our financial literacy and just taking steps towards your goal. So just keep in mind, being financially literate is not a sprint. It's one of those things where you just have to go ahead and just take and put one step in front of the other, just day by day, and then you're increasing your financial literacy. So just pick one section. If it's investing in your finances or house hacking or whatever it is, just remember, just starting with one is okay. You don't have to do them all. So coming in at number four, we have invest in stocks. I think that this is probably one of the more common ones just because it's so easy to invest in stocks, especially now that Robinhood's come out, with their free trading, which I've never said my opinion on Robinhood. I've had some negative experiences, but now TD Ameritrade is the broker that I use, has now gone to free trading, which if you don't have a broker, you can go and sign up at TD Ameritrade. So it's important to invest in stocks so you get to take advantage of compound interest. When you're younger, yes, 35, 40, you're still considered young. You have a higher risk tolerance, like as opposed to somebody that's like 65 or 70. And when I say risk tolerance, I mean you can gamble. It's not really gambling, but we'll just use gambling as the term, on stocks that could produce a higher yield, but also can fluctuate more. Basically, they have more volatility. So there's more chances they go up, 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 but there's also a great chance they go down, 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 down. For example, Tesla. Tesla goes like this, Procter and Gamble, kind of, so very low risk tolerance, but also low reward. And this is something as a young person you get to take advantage of. Another benefit to investing in stocks is you can start with almost no money. So you can't be like, oh, I'm broke, I don't have any money. You have a little bit of money. So take a look at this. Let's go ahead and say that you invest $300 at a 10% interest rate, which is the typical APY of a good growth stock mutual fund from the S&P over 40 years. That's from 25 to 65. And every month you deposit $200. Now keep in mind, this calculation is not including for inflation. So basically what that means is that you're always going to put $200 a month regardless of inflation, which theoretically with inflation you'd be able to put in more as time goes on, as the dollar gets devalued. So right here, as you can see, your initial balance of $300 plus $200 a month is worth 1.1, basically $1.1.5 million. And that's over $1 million just in interest. Here, I'm going to go ahead and scroll down. You can see you're depositing just $2,400 a month, or excuse me, $2,400 a year, which is not a ton of money. But you can just see the balance just tick up and up and up. Now, let's be honest. I know if you're thinking, oh, 10 years, that's a long way to think for the future. I need my money now. I want to be rich now. Well, investing in a good growth ROI mutual fund isn't going to be right now. Like if you're like, hey, I want to make 40 grand in net worth right away. Find a good fixer up in real estate. But, stocks isn't going to be that unless you're trading options, which is very risky, or you're very good at technical and fundamental analysis and can do some swing trades or some day trades. But we're just looking at long-term investing right now, for people that kind of want it to be more passive, because options and day trading and swing trading is fairly involved. So just as time goes on, you can just see, down here at 40 years, it's just worth so much money. So it's really like, can you afford to not invest? And just imagine, if you took a vacation every year for $2,400, after 40 years, those vacations would have cost you $1 million. That's a lot of money. So I'm going to go ahead and rerun the numbers. Let's say instead of at 25, let's say it's fully matured. It's still fully matured at 65. We're going to go ahead and pop in, 30. Because let's say you're starting at 35 and it's fully matured at 65, we're going to recalculate that same $300 investment, same $200 a month. It's substantially less. As you can see, that extra 10 years of compound interest really does matter. Now, like I said before, if you are 35 and you don't have a Roth IRA or traditional IRA set up, or you're not saving for retirement, now's the time to start. And it's not too late, and this is still a lot of money. Like, this is a lot more money than people think it is. Just after, you can see here, down at, year 10, we have it worth just over $41,000. Down here at year 15, we have the account value at $81,000. That's not a huge investment at $2,400 a year. And I bet you $2,400 is what people spend going out to eat. So I'm going to go ahead and touch on the IRAs just real quick. I know I mentioned them, but I didn't give any definition, just in case you aren't aware. And just so you know, there is a big divide in the community between a Roth IRA or a traditional IRA. Basically, a Roth IRA post-tax money, meaning when you get your paycheck, the taxes come out, and then you put the remaining money into a Roth IRA. But what that means is that after the money grows, you don't pay taxes at the very end. So the Roth IRA is post-tax money. What that means is that when you go on you get your paycheck, they actually take the money after the taxes have already been calculated and taken out. And then you put that money into your Roth IRA. So, let's say you're making $2,400 a month, and they take out $400 in taxes, and then you pay your Roth IRA out of that $2,000 that you have left over. But what that means is that when the Roth matures, you can usually start taking out after, I think it's like 59.5. The money that you make in the interest is all non-taxable because you've already paid your taxes down here. On the other end of the spectrum, you have the traditional IRA, which is pre-tax money, which means that they take out for the IRA before you pay taxes on it. So you can put in a larger amount because you haven't paid taxes on it yet. But then you pay taxes when it's matured or when you're allowed to start drawing from your IRA account. So basically, Roth IRA, start with a smaller amount, don't pay taxes after. Traditional IRA, start with a bigger amount. Theoretically, that would grow bigger because you're putting more money in, but then you pay taxes after. But honestly, as long as you pick one, does it really matter? I don't know. I'm not a financial planner. I'm not educated to give you financial advice. I'm just a guy on YouTube giving my opinion. But remember, the key is just to start. And then coming in at number 5, we have a used car. Now listen, I said used car, not cool car, not my friends will think I'm awesome car. Reliable, used car. Now this is probably one of the biggest mistakes I made in my 20s, was buying a car that I thought would end up being cool. You know, my friends are gonna like it, you know, they're gonna think I'm cool, you know, like all these things. Nobody thinks you're cool. You're basically trading money that you should be spending on a reliable used car for, you know, maybe 10 minutes of your friends being like, oh, cool car. But, you know, when your friends are all 40 and you still have this same reliable used car you bought when you were, you know, 26, they're going to be like, oh man, I wish I would have bought that. And I'm a car guy. I know the draw. But don't go buying a 2009 Audi A4 just so you can say you have an Audi. Don't go buy a Mercedes, you know, C300. Don't buy the BMW. You don't need it. Cars to buy: Honda CR-V, Accord, Civic, RAV4, cars like that. Cars that are gonna fairly hold their value okay. They're not gonna break down. They're cheap to fix. They're cheap to maintain. They're cheap to run. And yeah, no one's gonna be like, oh, you know, I wish I had your car, yada, yada, yada. But the amount that you would be spending to repair the car or just to keep it on the road, you could just use to invest. You could use it for a down payment on a house. You could use it to invest in the stocks. You could use it to, you know, go to trade school. There's so many other options for your money. Your car should not be a money pit, because let's be honest, if you don't have any other big assets, it's going to be the most expensive thing that you own. But anyways, I hope this video was helpful. Hopefully you enjoyed it. If you stayed this long, go ahead and hit the like button for the YouTube algorithm. That would really help me out. Also, if you go ahead and hit the subscribe button and the notification bell, that way you get notified every time I post a video, that would be really cool. Got any suggestions for videos you'd like to see? Also comment that down below. I'd love to hear them. Probably make a video on it. Like always, thanks for watching. I'll catch you next video.